Hey YouTube, hi friends, welcome back to the channel. Guys, in today's video we will discuss about an investing approach for retail investors which I personally rely upon a lot in my investing. Well, I'm a big fan of Warren Buffett and Howard Marks, and if you just imbibe that's what my understanding is. If we just imbibe the philosophy of these two great investors, we will be pretty much more than okay in our lives, because we'll make enough money that we can never even consume, or even our generations won't be able to consume. And these are very safe approaches to investing. So the first most important thing is these are very safe approaches to investing, meaning you will never be able to lose money over the long range if you just understand what we are doing. And by the way, this is not an investing advice by any measure. I'm not a financial advisor. I am a corporate guy. I have a master's and a PhD in engineering, followed by an MBA from ISB, and I do investing for my passion, right? I'm mainly in the healthcare sector, right? And investing and teaching about investing is my passion. That's why I'm just sharing my ideas over here, and you have full right to contest them, share your opinions in the chat, or follow if you find them useful. So what Warren Buffett and Howard Marks generally talk about, although Warren Buffett, both of them are really successful individual stocks investor, but they also talk about buying the index and the mutual funds. And more than that, they talk about the market cycles and when to time your investments. They have a way of teaching how to evaluate when the markets are expensive and when the markets are inexpensive. And whenever the markets are inexpensive, whenever the cycle is such that markets are inexpensive, that is where you increase your equity positions. And when the markets are expensive, you increase your debt position, so that when the markets become inexpensive again, you take a bulk position in the equities. Now this is a very simple investing framework, and we're going to apply this investing framework. So what we will do is we'll come up with an investing framework, right? And we're going to apply this into index funds and mutual funds, right? So one very important thing for us to understand is that when we talk about index funds and mutual funds, and this is for people who are absolutely new to the stock market, who don't know nothing about stock market. So index funds and mutual funds are basically what? Mutual funds, both these are funds, meaning they are a basket of stocks. They can have anywhere between 25 to 50 stocks or more. 50 stocks, right, or more. So mutual funds and index funds. Now what are index funds? Index funds basically follow the index of an economy, and index is a measure of the economic growth. So depending on the country, for example, in India we have NIFTY 50 and Sensex. These are the two indexes, and they represent the top 50 and 30 companies for index for Sensex, the top 50 and 30 companies of the Indian economy. So whatever the top 30 companies in Nifty, out of the 50 companies are automatically there in the Sensex, because these are market cap weighted indexes, right? So having understood this, one thing you would have understood that both these index funds and mutual funds are a basket of stocks, meaning they will reflect what is going on in the economy. So for example, India being a developing economy and is a healthy economy, meaning it's a democracy, it is developing, right? So the economy is increasing, and when the economy will increase, it will reflect in the growth of index, because index just represents the economic growth, right? Now what these mutual funds do, what they say is that index is bound to capture the top 50 companies, but we will use our intelligence to even research other companies out of the top 50, and some of them have the potential to grow even faster and higher and are better businesses. So they apply their intelligence, and they can perform either better or worse than the index. But mostly the fund houses are good, and even if they do a little bit of a research and have some systems in place, they are bound to outperform the index, and especially in the Indian context. Now, this is very important. In the Indian context, mutual funds have not done exceedingly well compared to index in US because it's a developed economy, and over the long run it is seen that index has outperformed most of the mutual funds. But in India the scenario is different. Being a developing economy, most of the companies here have growth potential, and if you do a little bit of research, you are able to find good businesses, which these mutual funds do. They are bound to outperform the index, and that is what is seen. That in India most of the mutual funds outperform the index, right? So they will be, if index is giving let's say 12%, they will be giving anywhere between 14 to 18, 19% over the long run, over the 7 to 8 years of time horizon. So this is a story of understanding that we will be trading in instead of the individual stocks, we'll be trading in the indexes, right? So here the advantages are unlike a stock. So if let's say you invest in any individual stock, for example HDFC Bank, right, and something happens to FDHC Bank, right, it gave a lot of loans and all of them starts defaulting. What will happen the next day? HDFC Bank will go bust. So the chances of it going to zero, right, its value reducing to zero, and in that case you can lose a lot of your money, almost all of your money, if you're only invested in individual stock. Now this can happen in stock, but in index, even if the economy gets a hit and it reduces or decreases to 60-70%, right, nothing will happen to you because the index will temporarily reduce by maximum of 50-60%. But since the companies will keep shuffling in the index, it will bound to grow with time when the next market cycle will come, right? So I hope this point is drilled on absolutely clear, that when you're investing in mutual fund or an index, you will never go to zero. But if you're investing in individual stocks as a beginner, you have chances to go to zero. Now I also have a significant portion of my portfolio in individual stocks, but that is my that is my risky portfolio, right? And I have a strategy which I follow over there, and I'll discuss sometime in the future about it. How do I do it? It's again a strategy which is giving me in the neighborhood of 35 to 45% CAGR in small cap stocks over the long run. It's a very great investing strategy according to me by Joel Greenblatt, and I'll discuss it in a separate video. But majority of my portfolio is in this kind of schemes, right? Index funds and mutual funds, which I would say is close to 65 to 70% of my portfolio. 20% is always parked in debt, and around 10% I have it in the riskier individual stocks. Now, the second very important point to understand is that you have to become a market cycle driven investor. And how will you decide? We have a very simple philosophy for this. We have a way to evaluate when the market becomes expensive and when it is inexpensive. There can be some falses, but mostly it is right, and it is very logical. So we have something called as debt instruments in the market also. Debt instruments, or we also call them as debt funds, which is basically nothing. You just consider them as your FD. There are of three types: liquid funds, ultra short, and gilt funds, depending on the maturity of the underlying bond. But all of them give you a rate of around close to 7% CAGR, right? But here your money is pretty much safe. The fluctuation is very less compared to any equity instrument, but it is pretty much safe, right? So this is important to understand because of the next thing which I'll be saying. So price to Nifty 50, we have to evaluate when the market is expensive and increase our positions in equity, or increase our exposure in equity, and evaluate when the market is inexpensive and then reduce our exposure in equity. So when Nifty 50 has you have to consider two things in Nifty 50. First is the price to earnings ratio of Nifty 50, and second is the earnings growth, right? Earnings growth I have previously covered in one of the videos. Check them out, guys. I'll link it in the comment section in the description below. But here P/E for a common investor, know nothing investor who doesn't know much about investing, is a very good metric. gives you a great idea about, gives you a good idea about whether the market is expensive or not. So according to me, from the past data, and we'll have another video on this, why these numbers make sense. But in the interest of time for this video, whenever the Nifty 50 P by E crosses over 22.5, which is exactly today, it starts to become expensive, right? Meaning the price you're giving for the earnings you're getting on the 1 unit of Nifty 50 is on the higher end. And that is where you become conscious as an investor, and you reduce your exposure. You start reducing your SIP amount, which is your systematic investment plan amount, which you're investing every month into Nifty 50. So above 22.5, you reduce your SIP amount by 50%. Meaning if you have 100 rupees to be invested, you invest 50 in Nifty and 50 in any of the debt funds. Okay. Above 24, it is very expensive. It does not make at all sense to get an equity position now. And at this stage, we reduce our exposure to 80% in debt. We increase our exposure to 80% in debt and only 20% in Nifty 50. But we always invest, so we will invest some portion. When the market is below 22.5 and above 18, when it is between 18 and 22.5, we invest 80% in Nifty 50, or it can be mutual fund on Nifty 50 index, right? And 20% in debt, right? And when the market is less than 18, when the Nifty 50 P by E is less than 18, you go 100% in Nifty 50 or index. Now this is what we have tried to do over here, is evaluate whether the economy is expensive and the market is expensive, and when it is inexpensive, and take in a positions. Now what is the beauty of this approach? Your accumulation will always be on the lower side, on the inexpensive side of Nifty 50. So one thing is sure to happen, that the companies will grow their earnings, right? And if you hold majority of your Nifty 50 below 22 P by E, and after 4 years or 5 or 6 years you sell at the same P by E of 22, you'll get the earnings growth for sure, right? So this is no brainer investing. Earnings growth in an economy like India of the companies over the long run would be anywhere between 12 to 16%, right? So this is simple logic to evaluate how to invest the bulk of your money into broad baskets, right? And then take advantage of the macro trends in the economy. This is something which I have been doing, and I would recommend any newcomer who's asking me about investing to do. If you like this video, do get a thumbs up. If you understood this video, let me know in the comment section below. If you have any suggestions, do let me know in the comment section below. Again guys, I'm not an expert. This is not an investment advice. I'm just sharing some knowledge which I have read from the books and from the Warren Buffett I have understood. Thanks again for watching the video. I'll see you again in the next one. Till then, take care. Bye bye, and I will see you soon. Thanks for watching. Bye bye.